Good Monday morning. Welcome back, Jim. Welcome back. I'm Fima, research analyst for ActionAlertsPLUS. Catherine Ross is off this morning, but we're going to dive into Deutsche Bank, the Fed, and of course market frothiness. Jim, let's actually do that in reverse order. In Real Money this morning, you were talking about, we did cool off a little bit off that hot jobs number, but we really have been at all-time highs. And in your Real Money column, you're kind of neutral on this market. So what I want to know is, what's it going to take to make you more bullish?
Okay. I need to see, I make fun of a company called Okta. Mm-hmm. Now I shouldn't, because Okta is a way of identifying yourself that basically makes it so that you can't, let's say you can't be duplicated. Someone can't hack you, all right? Kind of like LifeLock, but maybe beforehand, LifeLock being Symantec. And we got Zscaler. Now we've got the Real. We've got Beyond Meat, we've got Chewy. And
Tons of IPOs.
Sucking
up capital.
And although there's only been $39 billion that's been raised. Now, there was a person this morning on Squawk saying, wow, $39 billion. That's actually not a lot. The problem is that there are so many companies that sell at outrageous multiples to sales, not earnings, that those are the ones that are most vulnerable. And yet when you read the research about what's most vulnerable, they're talking about the Proctors being vulnerable, or the banks being vulnerable, or the restaurants being vulnerable. That's not what's vulnerable. It's these IPOs.
Right, and speaking of the price of sales, I know you've historically said, and things that maybe have changed over time, but 10 times sales is really that upper limit. But we've seen things go at 20 times sales, I believe.
But it always ends badly. I mean, one of the things that I recently did a piece and I for Real Money, and also did a thing on Mad Money saying that there's fraud. And then, well, what happens? They don't go down. And when they don't go down, people blame me for missing the last 50 points of Shopify, even though we own Shopify for Action Alerts. Look, I know what, I know what this is going to sound circular reason. I know what I know. I know what's changed. I know what's gone wrong. And typically what goes wrong is that there's a lot of equity supply, typically secondaries after they come public. We're not at the secondary phase. These companies just came public, but it turns out that the brokers learned from Lyft and Uber and went to all these companies and said, don't bring a lot of stock. Mm-hmm. Just bring a little bit of stock. We'll get people excited. The stock will go up, and then we'll do the secondaries. But when you look at, I was with someone this weekend who said, isn't Beyond Meat a short? I said, yeah, but everybody's shorted. Right. So you've got this crowded short phenomena of the IPOs. Then you have a stock like a Kohl's.
Not to mention what that means as far as the cost of shorting it. You gotta stand there. It's going to cost you a lot of money.
It's like your life. You got to identify stock beforehand. And then you got the banks. Everyone says like the banks are frothy. Cities. We did lighten up a little bit on Citi. Right. Why? Because we bought a lot of Citi. It was a big position. So I look at.
We're going to talk about that more on the
I look at what's expensive, right, and I say that's where the worry is. I look at what's cheap. Those finally started moving up. And those aren't shorts. So the analysts who are getting negative should be directly attacking the IPOs. That's where the expensive stuff is.
So it sounds to me like what you're saying is you want to see these low valuation names, some of the ones you called out this morning on Real Money, CVS, Citi, Kohl's. You want to see that stuff start firing. Yeah, and then at the same time, it sounds like you're saying is FOMO is not a strategy. And
right,
chasing this on fear of missing out is not discipline.
And I know that the guys who have said that Beyond Meat shouldn't double have been wrong, and there's no denying that. I think we were discussing this morning when we talked that in 1999, you were wrong to go short. Mm-hmm. In 2000, you were right. We have much better companies now. I think the ultimate is to look at Pets.com, where you had Ms. Wainwright was the CEO, and now she's the CEO of Real, which is a very real company. But I just am concerned that people don't recognize the risk of these new companies. Whereas I don't think there's as much risk in Kohl's or CVS.
Yeah, strong dividend, low valuations, absolutely. All right, Jim, let's switch it up real quick. A lot of Wall Street is believes that the Friday better than expected non-farm payroll report really takes the chances of a 50 basis point cut in July later this month off the table.
Was the straw man. It was straw man. Morgan Stanley makes the straw man case.
Right, that's never really been our view for 50. We do think maybe 25 though, but my question is, with Powell set to take the podium, for the semi-annual discussion in front of the House and Senate, what kind of language should investors be looking for?
I think that they need to see a Janet Yellen-like, which is that we got some strong numbers. but we're going to take an aggregate view. The rear view is jobless, but that number is strong. We're going to be independent of the president. Our job is not to make the Dow go to 10,000. I think he's going to be more pointed in his criticism because the questions will be more pointed. But ultimately, I think if you're data dependent, then you're fine.
And that's it, right? We want to hear data.
Yeah, we just don't want that blah, da, da. We don't want these Fed watchers to control the dialogue.
Yeah, because you did mention data, though, let me just ask, do you think the Fed is still working on these older models that maybe haven't taken into account the dynamics of, say, technology or Amazon, which has really kept inflation low?
There was a note, say, about Amazon Prime coming, and there was a minimum wage $15 and a Minnesota strike. Okay, when I look at Amazon and I look at what you used to make at Macy's, all right? I mean, Amazon has put a lid on a lot of things, and I don't think the Fed has yet, Bullard's tried, but I don't think the Fed has yet to be able to get their arms around the new economy, and their analysts are surprisingly obtuse about the new economy and the pressure that the new economy puts on the old economy on a daily basis.
And the one other thing we were just talking about it right before this, so let me ask, is historically also the Fed has looked at something like an unemployment rate, right? Like the unemployment is too low, the economy is too hot, we got to keep the rates high. But when you consider that the participation rate is something like 63, is the unemployment rate maybe not the best gauge for the Fed to use?
I don't want to look through something that, as I described in Get Rich Carefully, you can't really make a case that you can ignore that number.
Right.
But the participation rate has been, to me, a safety valve, and it's still way below where it should be. Now, a lot of that is because of disability, but a lot of it is that there are structural problems. And opioid, opioid. It turns out to be far bigger than we realize.
It's affecting a lot of people that would otherwise be at work.
Yeah, exactly. And I look at the opioid crisis, and I see there was a very good, interesting article in New Yorker about the Democratic campaign in Iowa. And someone just says, listen, my town was decimated by opiates. And you listen to that and you say, wow, there's structural unemployment. And no one, Alan Kruger, who was a fantastic economist, who sadly killed himself, he was one of the few who said this is a big reason that we have structural unemployment in this country. And Kruger was a genius, and so sad. We don't know much about, well, you never know what happens in people's lives, but he was aware of this and would say, participation rate, don't forget opiates, major reason why we have a very low, a much lower participation rate than you expect.
There are definitely factors to keep in mind, but when it comes to Jerome Powell tomorrow, it's data dependency that we're going to want to focus on. Jim, let's switch it up real quick. We're going to jump over to Real Money stock of the day, which is Deutsche Bank. Kevin Curran's got you covered on that over at Real Money, by the way.
Great stuff.
So real quick, just some background. Deutsche Bank.
Yes. Deutsche Bank. Because once again, this time they're getting rid of what they bought, Bankers Trust, 1999, with Frank Newman, who was a terrific guy, sold it to them. Look, this is good news for every other bank. I mean, people forget, you take out a player.
Right, real quick, $8.3 billion in restructuring. They're getting out of the global equities business.
Man, are they bad.
Right, and we're talking about, now, if you are investing this, you're thinking about, you have to get over to Real Money because we're also talking about $3 billion in a $3 billion hit in the second quarter, which is expected to lead to a $2.8 billion loss.
Right, it's just a terribly run bank. Right. Terribly. And it never raised capital. A lot of these banks never raised capital. The reason why our banks were forced to raise capital, and I know Dick Kovacevic at Wells Fargo has been leading the charge saying that should never have happened. But the fact is that our banks are stronger because the government said you must raise capital. And by the way, a lot of the banks still have way more stock, even though they buy back stock aggressively versus where they were in 2007. So it's something to keep an eye on. When the banks finally get to where they were, then you're going to sense when you should be worried, not yet.
So my question also is, though, with this shift from the struggling business back to a client focus, is this the reinvention we've been looking for, or is it too little too late?
Too little too late. It's just not a major bank anymore. It's a minor bank.
All right, thanks, Jim.
Banco Santander is bigger. That's the one we should be talking about. We should be talking about what Anna Boutine's doing.
Might have to do that tomorrow for the video.
Let's go.
We'll see. All right, Jim, thanks so much for your time, guys. Again, Deutsche Bank is our Real Money stock of the day. Kevin Curran's got you covered. I saw his first article this morning. He's really attacking all the angles. Be sure to check that out. Catherine Ross will be back tomorrow. I'm Zeb Fima for TheStreet.com.